everyone, this is Robert Wade. Welcome to the Elliott Wave Options U.S. Market Update. A lot to talk about since we did our outlook for 2020. And by the way, we had an overwhelming response to that. Huge turnout. Thanks to everybody that took time out to watch that video, attend live, or watch the recording. If you haven't, have a look at it. A lot of really good information in there. Some of the stuff we're going to refer to in this recording as well. But one of the main things that I wanted to talk about that's occurred since then was Chairman Powell did his talk in front of Congress. It used to be called the Humphrey Hawkins testimony, where the Federal Reserve Chairman was, quote, required, but, really it was legislation that eventually expired, hence the names Humphrey and Hawkins that are neither one in Congress anymore. But the Federal Reserve Chairman still comes basically twice a year and talks to Congress about what's going on in the financial markets. And the big subject was, of course, the coronavirus, which we mentioned as a potential black swan in the outlook. And that's obviously gotten a lot worse. It's pretty much shut China down. So there's a lot of speculation of what's that going to do to the overall world GDP, not just what's happening in China. Is that going to affect the U.S. markets or not? And then, or how much is it going to affect? And then one of the interesting things is that in the past, when we've had these kind of things, SARS, other type of, quote, natural disaster type things, hasn't really prompted action out of the Federal Reserve. They've kind of let things to go their own way. So is this going to be the same way, or is this going to have a little more effect? The reason I say this is the Fed Fund Futures is starting to price in potentially one, maybe two rate cuts this year. Is it because of the economic slowdown? Is it because the virus gets so much worse? The world GDP, what's the reason for the pricing in? But it's interesting. It's something we have to pay attention to. One thing I always say is that you must pay attention, even as an equities trader, you must pay attention to the bond markets because they tell a lot about what's going on. There's a lot of very smart people and a ton of money in the bond market. So let's take a look at the charts because I want to come back and refer to that comment about bonds when looking at the charts. Let's have a look. So as you can see here in the chart of the SPY, we've moved to the upside. We had a nice move down here to the 138.2% retracement level. That generated a really nice gain of better than 100% on some puts for our subscribers. By the way, the subscribers have enjoyed a really good December and January. 16 out of our 17 closed trades in those 2 months were all winners. So subscribers are quite happy over the last couple of months. And we're marching up to that next potential fib level. And if you were in the outlook, you've seen this. If not, I'll go ahead and show it to you. We have three different potential patterns that are showing a 346 price level on the SPY. There's a green, purple, and red. They're all detailed in the outlook, so watch that recording if you haven't. And you can see one of them here was a potential correction down to the 100% level. Well, so far the 138.2% level has held, as you just saw in the charts, and we're moving up towards that with three different patterns showing a same price level. Obviously that's going to be pretty major resistance when we get there, and then we move up to the 362 level, and pay attention to that because I'm going to show you where that is on the S&P chart here in just a second. But coming back here, looking at the move to the upside, one thing that we have to keep in mind, and a question may be, okay, well, do we have calls out for our subscribers? No, we have some bullish trades to take advantage of this upward move, but you've got two gaps right here. So are those gaps going to get filled before we march higher, or are we just going to go straight on up? The SPY, the gaps usually get filled fairly quickly. So I want to keep an eye on that to see if we do get a retracement before we move up to that 346 level. And then looking up here, there's that 362 level, which happens to be the 261.8% fib extension level. And remember, I've only seen that a couple times before. Saw that back in 1999, 2000 area, and then also back in 2007. So those were two times when we had big extended runs like that. And then you know what happened after those two runs. So that's something we might have to pay attention to down the road. Well, something else that I wanted to mention, I talked about the bond market in the intro, and so I wanted to show you this. Now, we've been looking at this a lot. We've been looking at TBT, which is inverse to the 20-year Treasury. So when you see the prices going down, because it's inverse, it's actually showing what rates are doing. Normally, when prices of bonds goes up, yields and rates goes down. But since this is inverse, this is actually reflecting, it's the short against the 20-year, it's actually reflecting exactly what's going on with rates. So you can see rates are coming back down. Now, we had mentioned in a past recording that we were likely going to come down and test these lows. Well, we did that, and we kind of slightly broke them and then bounced up, and now here we are back down again, and we're in a wave 3 to the downside with this correction level. And so if we take a look to see what this correction is, and it's not even a 38.2% correction, which in my book doesn't count then, so we're still in an impulse move to the downside. We could bounce back up here to this 4 at some point in time, or rates are going to continue down. So is this a reflection of the Fed fund futures? Very well could be. Remember, I mentioned they're pricing in 1, possibly 2 rate cuts. But here's something that's a little bit worrisome. Now, this is the HYG. So this is the iShares high yield bond ETF, and this is not inverse, so this is actually reflecting the prices. So this is actually the price of high yield bonds, and you can see people are buying them, they're bidding them up. This is in a wave 5 to the upside with a really nice 50% wave 4 corrective level, and then we're moving up from here, and you can see we've had a couple gap up moves here. So people have, at least right now, a pretty good demand and a nice thirst for these bonds. But is there maybe too much junk in the trunk, as they say? Well, let's take a look at this chart. And this is something that I find pretty interesting. This is from Bloomberg, and you can see that this is showing you inflows into the high yield bond market, and you can see that over this past year it's been moving to the upside and moving up the past couple of months, which is reflected in that chart. So a lot of money moving into junk bonds, and usually when that type of thing happens, people are chasing yield, right? Because you can't get yield anywhere else. So where can you get it? In junk bonds. Well, what are you doing when you're buying junk bonds? Well, you're earning a higher rate, but why are you earning a higher rate? Because you're taking more risk. So when people start to let that risk appetite wander a bit and maybe not be as prudent as they were in their risk management before, it's a worrisome sign. So it's just something that we're going to need to pay attention to, but hadn't shown you that chart. So we thought that it'd be interesting to see, are we going to run up and hit this wave 5 target? And then take a look at this. The dollar is flying again. Maybe because of the coronavirus, could very well have something to do with it, but it's in a wave 3, just powering to the upside. In fact, a very vertical move. That will get to a point where it starts to put pressure on multinational companies as well as far as the exchange rate. So imagine the coronavirus getting worse and affecting global trade, and then the dollar getting stronger, affecting global trade. You can see a scenario for a correction somewhere down the road. So if we make it to that 346 level, are we going to actually get to the 261.8% extension? It's going to be fascinating over the next couple of months to see what happens, but we're really on top of these levels, and things are falling right into place from an Elliott wave Fibonacci standpoint. And let's put the moving averages on here, and you can see that right now the dollar is a bit overbought. So we're up here. Here's the 10-day moving average. There's a little too much separation there. Remember, no security in any time frame gets very far away from its 10-day moving average. So one of the things is going to happen. Either we're going to go sideways here for a while at that resistance from the high back in the beginning of October, or we're going to back up and come back down to the 10-day moving average. So we go sideways and let it catch up, or we come back down to it. In a strong wave 3 like that, consolidation is more likely than a correction, but either one of them could occur. And we had a little correction right here back on the 31st of January. We could see something exactly like that. And then looking at the VIX, remember we were talking about this big descending triangle that we had in the VIX, and just like triangles in any security, we got the volatility breakout. There was the big move to the upside, which allowed us to get that nice gain on the SPY puts that we had on that volatile move, and now we're starting to creep back down. But with the VIX still above 15, there's still a little ammunition there before we work our way back down to that 12 level, which has acted as support so often for a continued move to the upside. So plenty of things to keep an eye on, especially the bond market. So hope you found that informative. Look forward to talking to you again next time. Take care, everybody.